Thank you for joining us for a presentation from QuotedData's Round the World webinar series, America's Session. I'm joined by Jerry Polacek and Matt Ordway, members of the investment team responsible for managing Ecofin U.S. Renewables and Infrastructure. I'll pass over to Jerry and Matt to talk through the fund for you.
Thank you for joining us today to learn more about accessing sustainable dividends through RENEW's differentiated investments in U.S. solar and wind assets. Good afternoon, I'm Jerry Polacek, a managing director and group lead for Ecofin's renewable energy private investment platform. I started investing in this asset class in 2000 and have closed and managed several $1 billion of private renewable energy investments over my career. I've been fortunate to be part of a cohesive senior investment team that's been together since 2014 and at Ecofin since 2016. With that, I'll turn it over to my colleague, Matt Ordway, who I've known professionally for almost 20 years, dating back to our early days investing at General Electric.
So as Jerry mentioned, he and I met working at General Electric several years ago, investing in power and other energy infrastructure assets. While I was working there, I got involved in the development of a 1 gigawatt power project, and it piqued my interest in the development side of the business. I left GE and spent several years working as a developer. And then about 6 or 7 years ago, as Jerry mentioned, we got back together to form a prior firm, and we've been investing together since 2014. So with that, I'll turn it back to Jerry.
In creating RENEW, we filled a void in the London market to provide investors direct access to a diversified portfolio of US solar and wind assets that sell power under long-term fixed price revenue contracts. With Ecofin's seasoned US-based investment team focused on the growing middle market, we've been able to secure investments bilaterally and avoid auctions, which translates to better returns relative to the large-scale renewables segment. Lastly, through investments in solar and wind assets that use proven technology and have contracted revenues, RENEW provides investors with a stable source of sustainable dividends that are largely uncorrelated to public securities markets. Next page, please. As we noted, RENEW provides access to the US renewables market, which is one of the best globally, with a low penetration rate relative to the UK, a highly supportive policy environment, and a scalable $350 billion investment opportunity. With RENEW's first full year completed, we were pleased with the substantial progress made to achieve the objectives we laid out as part of the IPO in December of 2020. On deal sourcing, we achieved full deployment of proceeds within 10 months of RENEW's IPO versus 12 months set out in our guidance. Not only that, we delivered a diversified portfolio of 8 solar investments and 1 wind investment across 6 states, with fixed price revenue contracts having a remaining term of almost 17 years. The strength of the portfolio is also evidenced by its dividend performance. We declared RENEW's first dividend in Q1 of 21, which was 1 quarter ahead of IPO guidance, and each quarter's dividend has increased since then. In January, we announced a dividend of 1.4 cents per share, bringing the aggregate dividend yield to 3.2% for 2021. This outcome exceeded our dividend forecast of 2 to 3% for 2021, and it puts RENEW in a good position to achieve its 5.25% to 5.75% targeted dividend yield this year. Looking at NAV, it is up 2.5% as of December 31st, 2021. We also raised a $65 million credit facility on very attractive terms to fuel RENEW's growth. Looking ahead, we have a strong pipeline of more than $100 million of solar and wind acquisitions, either under exclusivity or committed to provide a glide path for growth in 2022. Next page, please.
Our investment is on U.S. renewable energy assets in the middle market, which we believe is a less crowded segment with greater opportunities to add value by sourcing investments directly with sellers outside of large auction-led processes. We targeted solar and wind assets during the construction and operating phase, which comes after the higher risk development phase is completed. We found that the mid-sized developers we work with, they offer the same high quality assets using proven technology with long-term investor-grade revenue contracts, very similar to their larger competitors. However, we see that these mid-sized developers, they're more willing to engage bilaterally when they find a reliable takeout investor and can avoid the cost and hassle of large auction-led processes. Next slide. So not only does ReNew invest in sectors and assets that directly contribute to the reduction of greenhouse gases, but we also do so with ESG criteria integrated directly into our investment process. For instance, we've developed an ESG due diligence risk assessment framework that's completed for each investment opportunity, and it's reviewed and approved by our investment committee prior to the investment approval. We believe that this process takes a broad view of ESG risks and provides opportunities to mitigate risk and deliver better outcomes for our investors. Next slide.
Shifting to ReNew's portfolio, we've built a truly diversified set of U.S. solar and wind assets. And you could see this through a variety of factors. So geographically, it includes 61 assets spanning 6 states to provide both resource and state regulatory diversity. From a technology standpoint, it includes about 2/3 solar and about 1/3 wind as a function of cost. The portfolio is overwhelmingly operational, with about 79% in operating assets and about 21% in construction stage solar assets. As for the credit quality of the revenue contracts, you could see in the pie chart below that the investments are underpinned by strong investment grade quality power purchasers with a remaining term of almost 17 years, which translates into a high degree of predictable revenues. So in summary, we believe that this portfolio provides a strong foundation for delivering dividends and ongoing growth. Let's take a closer look at 2 of the more recent acquisitions that we've made. So Whirlwind is about a $49 million acquisition of a 60 megawatt operating wind project in Texas. And the Eco solar portfolio consists of 11 construction stage solar projects across 3 states. With both acquisitions, we avoided auctions and bilaterally originated the investments through our team's proprietary sourcing network. Both investments use proven technology, and they sell power under long-term fixed price revenue contracts with investment-grade utilities to provide stable cash flows. We believe that these high-quality assets align closely with ReNew's strategy.
This chart shows a few sensitivity cases we've run on the portfolio. While NAV is most sensitive to merchant power prices, it may be surprising that it only moves NAV up or down by about 6%. This is due to the long-term power purchase agreement, or PPA structures we have here in the US. The exposure to the merchant power price curve doesn't occur until the PPA expires, typically 15, 20, or even longer into the future. As a result, the merchant power prices would have a much lower impact on the overall returns than a similar project in the UK. Second sensitivity shows the NAV's variability due to the discount rate. You'll see here a 50 basis point movement in discount rates moves NAV up or down by about 5 or 6%. But as our portfolio scales, we would expect that the fund would benefit from yield compression, so it's more likely the discount rates will move down or in our favor. The third sensitivity shown shows NAV's variability due to power production, which is simply the measure of the variability of wind or solar resource. In the P75 or 25 case, NAV will move it up or down by about 3%. The P75 case simply means that there's a 75% probability that the wind or solar resource would exceed that amount in each and every year. In reality, we wouldn't expect the wind or solar resource to be below average levels in all 35 years, and some will be above and some below. The last 2 items here, inflation moves NAV by about 3%, and this is due to the fact that many of our costs are under fixed price contracts, insulating the portfolio from that. And the last is a 10% swing in operating expenses would similarly move the portfolio's NAV by about 3% up or down. Next slide. So you may ask, why invest in the US market now? As you can see on the chart on the left, this compares the unsubsidized cost of power generation across wind, solar, gas, and coal. And as you can see, the cost reductions we've seen in the past decade are allowing renewables to compete on a head-to-head basis with gas and coal without the tax incentives that the industry benefits from. So what I can say is that while the past growth of the industry was due to subsidies, future growth is really being driven by the economics. The US is going through an energy transition right now to a less carbon intensive grid, and it's entering this new phase of growth. And as you can see on the chart on the right, the US renewables industry is expected to roughly double its market share over the next 20 years or so. This provides about a $350 billion investment opportunity, and it's due to three things. The first is improved economics of renewables that I mentioned earlier. Second is the favorable regulatory environment we live within. And third, and most importantly, is a strong pull from consumers for cheaper, sustainable power sources. Many customers are choosing to sign these long-term PPAs simply to lock in the cheap cost of power for many years to come. So you may be wondering how the US market is different from the UK. We list out 5 items here that we'll talk through. The first are the long-term revenue contracts I mentioned earlier. Many investment-grade quality power purchasers are willing to sign long-term fixed price contracts to buy power for wind and solar projects. These PPAs tend to be 15, 20, even 25 years in duration, and many of them have inflation protection built right in. The second item on the chart is market exposure. I'd say this is the most important for investors to understand. It's the fixed price nature of these long-term power purchase agreements that it reduces the investor's exposure to merchant power price volatility. The third item are incentive schemes here in the US. The renewable energy industry has received decades of federal support, principally in the form of tax credits, which provided the support the industry truly needed. But as the costs have come down, the necessity of those is less. But the second item we'll talk about, renewable energy in the US has benefited from strong state level support as well in the form of renewable portfolio standards, or RPS. These exist in 30 of the 50 states. The RPS requires utilities to procure a minimum level of renewable energy every year. And utilities typically meet these requirements by signing long-term power purchase agreements with solar and wind projects, or by directly buying the renewable energy credits or RECs. The last 2 items here, the irradiation and renewables mix. The US obviously has a strong solar resource, a large land mass, and the renewables mix is, interestingly, it only makes up about 25% of the overall installed base. So there's lots of room for us to grow. Next slide.
So to provide a snapshot of the US renewable energy market today, we expect solar and wind will be the dominant source of new power over the next decade under all major scenarios. Today, we have federal policy certainty around renewable energy credits and sustained bipartisan congressional support for the sector due to the large number of jobs spanning all 50 states. Finally, the Biden administration has combating climate change as a centerpiece of its policy agenda, with a recent goal for the US power sector to be decarbonized by 2035, which is a monumental target considering that almost 60% of the power grid last year was powered by fossil fuels. While we see some near-term challenges such as equipment inflation and supply chain issues in the near term, the growth prospects for the US renewable energy market are incredibly bright. Let me wrap up with a few highlights. So what are the key points that we believe sets Renew apart? To start, this is the only UK investment trust with a diversified mix of US solar and wind assets in the middle market. The fund's assets have long-term revenue contracts with investment-grade purchasers, which eliminates exposure to volatile power prices and is a clear differentiator. These factors provide us with confidence in offering a sustainable dividend yield of 5.25% to 5.75%, with attractive net total returns of 7 to 7.5% and low correlation to public securities. Investors gain access to the US renewables market, which is one of the best globally with its low penetration rate, supportive policy environment, and a scalable $350 billion investment opportunity over the next decade. The fund is led by our seasoned US-based investment team that has a combined 50 years private investment experience. Critical oversight comes from a diverse and experienced board and an ESG-aligned strategy. Through the fully invested portfolio of 100% contracted solar and wind assets with almost 17 years of contracted revenues, we've created a diversified portfolio of predominantly de-risked, cash flow yielding operating assets. Our strategy is further distinguished by the team's proprietary sourcing network and over 100 million of either committed or exclusive investments in our pipeline today. Collectively, we believe that these factors represent a formidable advantage and offer compelling value for investors seeking a resilient source of dividends and attractive total returns. I'd like to thank you for your interest in ReNew.
Thank you both for running through how ReNew works. I think it's a very interesting topic and one that many investors should be looking at to include within their portfolios. Please look out for other video recordings on our Round the World session, which are available through our QuotedData website, quoteddata.com, or via our YouTube channel. Thank you for joining us.